This is the brief on the payment of Gratuity Act 1972. So this is a really key piece of Indian law, right? It basically says employers with 10 or more people have to give you a lump sum payout that's your gratuity when you leave after long service. And get this, once a company is covered, they stay covered, even if their employee count drops later. Okay, so let's jump into what you really need to know. There are 3 key things here, covering eligibility, when you get paid, and a super important tax detail. First up, eligibility. Now, the law mostly talks about 5 years of continuous service, but here's the thing. Courts often say, hey, you know what? Completing 4 years and 240 days, that counts as 5 years. Good to know, right? Oh, and that 5-year rule, it's totally waived if someone sadly passes away or becomes disabled because of an accident or illness while employed. Second point, and this is crucial, your employer has to act fast. They can't just wait for you to apply. Nope. They need to figure out your gratuity and sort out the payment within a strict 30-day window from when it's actually due. If they're late, they automatically owe you simple interest on that amount, usually around 10% per year. Remember, the maximum payout currently is capped at 20 lakh rupees. Finally, and this could make a huge difference to your wallet, the tax situation. Under the old tax regime, your gratuity exemption goes right up to that 20 lakh limit. But under the new default tax regime, which is now the standard starting fiscal year 2024-25, that exemption, it plummets to just 5 lakh rupees. Yeah, so if you're expecting a decent payout, choosing the old regime is pretty critical for planning. Look, this act really sets out clear financial duties for companies and gives vital protections to employees right across India.